Just first, a general question about the market environment. There seem to be, I'm sure there are more than two camps, but right now it seems like there are people just waiting for the capitulation, waiting for the market to inevitably turn properly and the recession to come. And then those that are saying, what are you talking about? Fundamentals are fine, companies are getting to spend their money in all sorts of ways, and we're pretty healthy, the bull run continues. Where are you?
So I can't talk about bull runs, and I'm not a stock market guy.
Sure.
But I can tell you from an economy perspective, I think we're in pretty good shape. I mean, I don't know if it was baseball, I don't know if we're in the 7th inning or 8th inning. It's been a very long run. But the reality is the recovery and this GDP growth has really been more gradual than in years past. So I think it's got room to continue. There are things to worry about. I worry about China and trade war. I worry about Europe and Brexit. But you know, America's economy is a sort of juggernaut. Think of it as a tanker moving. It's not going to move off course that quickly.
As the stock market has, got more and more healthy, and as the Dow has gone higher and higher and so on, it's become a market that suits the likes of you a lot more, right? So we're seeing sort of innovative things being done by companies. It's not your usual sort of grow the dividend, buy back some shares. We're looking at breakups. We're looking at different kinds of mergers.
Yep.
What's been most interesting about that for you?
Well, capital has remained inexpensive. I think that's probably the biggest variable. I think a lot of people expected that with the bull run and with the GDP growth that we've been having, that at some point rates would start to rise. They haven't. And I think that's created opportunities. There's a bit of a window where capital is readily available. There is still value to be found. I mean, as you know, I do these special purpose companies, very different from American-style SPACs. I want to caveat that. And we do them in scale. But so finding opportunities where there's a good spread between the public markets and private markets, it's still out there. It's just hard, it's hard to find.
One of the places where obviously you're looking for those opportunities is with J2, your SPAC. Now, my understanding is that if you get to October and you haven't found an acquisition for it, there's potentially some liquidation event.
We can extend it for a year.
Okay, where are you seeing the opportunities? What looks good in the market?
We've looked at a number of different areas. We try to keep to our core criteria. So we look for market leaders in niche markets with defensible moats, with high histories of strong free cash flow generation, run by good management. And we're almost industry agnostic, but we tend to go towards manufacturing, industrial space, and consumer. And we found a couple of interesting things. We got close to one or two things last year. Didn't act on it.
Why not? What was the sticking point?
For us, it's always evaluation. We don't spend time on things that we don't think would be a good fit. But we're pretty disciplined. We're very disciplined. And, if I don't see real upside, not just short term, but long term for our investors, there's no point in me doing it. I'm investing a lot of money myself. I don't get free shares like SPACs in America do. I have to create value for shareholders, which is the right alignment of interests. And so we are disciplined. But, I'm pretty confident we're going to do something.
And talk to us about Element, because company, last time we had you on, known as Platform Acquisitions, you obviously sort of reconfigured the company quite significantly. Now, it's really under-levered, at least by the standard that sort of you are traditionally operating a lot of your businesses is about 2.75 times. It also has a lot of cash. So seems obvious that it's going to go out and do some M&A.
We talk about Nomad or Element?
About Element.
So Element, we're not going to do any M&A of any size for the time being. We're going to run the business and let the standalone Element Corporation show its cash flow generative capabilities as a standalone entity. We haven't even had one full quarter as a standalone company since the sale of Arista Life Sciences for about $4.2 billion. Completely delevered the company, as you said. It's a great business. It's a real strong, high free cash flow generation business. It's been a little unlucky. The trade war in China has affected the electronics business in Asia. That obviously will flow through at some point.
How do you deal with that? What's the play running a company that does get a lot of base materials from China in this environment?
So we've got a lot of customers that are actually moving manufacturing over to places like Vietnam. That's a process. We're well positioned in countries outside of, within China and also outside of China and other parts of Asia. and we'll be supplying those customers. But there's a lag. So you've had, softer end markets, because what's happened really is Chinese manufacturers have tightened up on inventories, but the end market demand is still there. So that lag will catch up. And so we feel pretty good about the business. Whether it all happens in the second half of 2019 or not, I don't know. There's a lot of people who've felt that it's going to be that way. I think some of it depends on the environment, again, between China and the United States in terms of trade.
So longer dated capital is out there. There's lots and lots of it, and you're attracting it, I'm sure. What are your metrics when it comes to longer dated capital in this environment, given that so much of it is going to PE, so much of it is going to this infrastructure play that may or may not happen in the United States? How do you attract it?
Well, I think the infrastructure is coming because the country needs it. And at some point, the politicians will push all that aside, probably after this election and the next round of presidential elections. They'll do something at Congress. From our perspective, we are staying relatively conservative. I mean, we have another company I co-chair with Noam Gottesman called Nomad Foods, our frozen food business. We're sitting on, I think, $800 million or so of cash, and running with a very unlevered balance sheet. It does give us capacity that if we find something really interesting or transformative that on an opportunistic basis, there is long, relatively inexpensive on historic basis capital available. But I think at the same time, as I said at the beginning, it's, if you're in the seventh inning of a cycle, you want to stay conservative. You don't want to find yourself stretching a balance sheet and then finding that you're actually in the ninth inning.
In the Nomad Foods area, Kraft Heinz would be one to be looking at, and I'm curious as to what your thoughts are on what Kraft should do, what it should offload, and if you're looking at any parts of the business, or if it should spin off any bits. I'm
a believer that when businesses are not performing, the last thing you should do is sell them. I believe you should, and I'm friends with a lot of the guys at 3G, and I've told them that's my philosophy and would be my view. I think that you fix businesses, and they've got a great portfolio of brands. They're going to be fine. It's going to be a long game, but it's the same thing as I said back in the Newell story when I was on the board there and came off. The answer is to fix a business, not to divest assets. It's a path to value destruction, I think.
If you can, handicap for us Newell at the moment, because I looked at the shares just before we came on, I think the lowest since 2011. You've said consistently they shouldn't try and M&A their way out of the situation they found themselves in. Is the company, is it going to get worse from here? Do you think it's fixable?
Well, as you know, I haven't been inside it for quite a long time, and I'm not a shareholder. But obviously I care. There are still people there that used to work in our Jarden organization and our family. Look, it's not easy. I think, again, when you sell off plum assets that have a lot of growth, and you've got other businesses that you need to turn around, and you still have a lot of leverage, and you still pay a big dividend, not a lot of capital to do the fixing. So something's got to give. And I think that's reflected in the stock price. But I'll go back to what I said before. Unless you get organic growth in a business, and you start generating real free cash flows and do the basics, you're not going to create value. You can't M&A your way out of that. It doesn't work.
All right, talk about organic growth. One story that's captured a lot of headlines recently is Beyond Meat and the kind of absurd or justified, if you look at it that way, growth that they've had since going into the public market. With a company like Nomad, which is a sort of, I think of as a more traditional food business, frozen foods, do you look at something like Beyond Meat and think, this is just completely unreasonable? Like, we're growing at our steady sort of 5-10% a year, and this company's gone up 200% or whatever in just a few weeks.
Well, I think that it'd be nice if we had their multiple. I think the reality is when you have something new that's introduced that's hot and growing at a high organic rate, you get those kind of valuations, and that's fine. What I think is important that investors understand is companies like Nomad are actually perfectly positioned. About 85% of the portfolio is what you'd call healthy foods. We're very focused on plant proteins.
Can you do plant fish?
We can't do plant fish, but we've got the plant burgers and various other products. But at the end of the day, it is on trend with consumers. It's very much on trend with consumers in Europe. And we're launching a lot of products on the back of a very respected and trusted brand portfolio with those new products. So we feel like we're in the right place at the right time. It's why we've got now, I think, 10 straight quarters of organic top-line growth in the business, and I think that will continue. So, you know, I don't know about whether I would look at the upside from here with a Beyond Meat kind of multiple, but for us, we think there's a lot of upside from where we're sitting, and you know, that's worth continuing to drive towards.
It's trading right now at 94.79. It did break through the $100 mark, I want to point out earlier on. Just give us, if you can, a little more detail on what you might be looking at, both for Nomad with your $800 is in cash, 800 million in cash, and also J2.
Yeah. So I guess on Nomad, the kinds of businesses we're looking for are more of the same of what we've been doing, which is strong market leaders with brands in niches in Europe in the frozen food space. Mm-hmm. There are a lot of additional bolt-ons that could be great for our business. We're looking at some at the moment, and we'll see, but we're being very disciplined. I'd say on the Jarden side, it goes back to our criteria of looking for leaders in their niche markets, and I think that, you know, we've circled onto some opportunity that exists for us. There's not much, obviously, I can say as a public company, but when we get to the point of putting ourselves in a place where we can publicly announce it, I'm sure you guys will know.
All right, just really quick, last question, Martin. You're someone who's done a lot of debt deals, you've borrowed a lot over a long period of time. How would you handicap the credit market environment that we're in right now?
I think it's pretty good. I think rates are going to stay low. As always happens when the market gets frothy, you'll find some sort of second-rate creditors doing credit deals they probably shouldn't do, and they'll be the first ones to get hit when things turn. But I think this market is going to stay. You know, it's a buyer's market for, or rather say, an issuer's market for credit today.